Hi there. My name is Victor Aluyi, and I'm the head of investments at Sankore Global Investments. And this is your weekly financial markets roundoff. We start off in the US markets, where stocks rose on Friday to cap their best week in 2024, as the market essentially looked forward or is looking forward to the outcome of the Fed meeting this week. The S&P climbed 0.54% to close at 5,626 points, less than 1% from its all-time high that it touched in June. The Nasdaq Composite added 0.65%. I mean, both indices basically posted their fifth consecutive winning day. So last week was a very strong week. Every day, these indices essentially closed positive on a daily basis, while the Dow jumped 0.72%. The rally was really being helped by a rebound in mega cap tech stocks following their recent underperformance, which created a really strong buying opportunity. And market participants began to look at these stocks as being at really good bargains, and that saw a very strong move last week. For the week, the S&P rose about 4%. The Nasdaq was up about 5.9%. This was basically the best week this year for both indices, while the Dow rose 2.6%. The market really would largely be focusing on the outcome of the Fed policy meeting, this week, where the Fed really is largely expected to cut interest rates by 25 basis points. Recent economic data reflecting a moderation in inflation seems to be supportive of a rate cut. August CPI came in at 2.5% year on year, which was the lowest that we had seen since February of 2021, and was also in line with market expectations. However, there are sections of the market that hold the view for a stronger 50 basis points rate cut by the Fed, citing the fact that the Fed was already, is already really behind the curve, on rate cuts. So it really remains to be seen, although the market really largely expects a 25 basis rate cuts. Market will largely be looking forward to, beyond the rate cuts, a bit more clarity and some sort of forward guidance, really, on the strength of the economy, the labor market, and also probably the rate path that the Fed is likely to take. We, however, think that, in the wake of this rate decision that we're going to see tomorrow, there is likely to be some volatility, in the market, really. Over in Europe, the ECB lowered its benchmark, rates by 25 basis points last Thursday, marking its second rate reduction this year. This was a move that was widely, anticipated after a period of sluggish economic growth across the, Eurozone, and also cooling inflation, which basically fell back towards the 2% target of the ECB in August. Also, the ECB lowered its 2024 growth target to 0.8%, just slightly lower than the 0.9% that it had earlier predicted, essentially citing weaker contribution from domestic demand over the next few quarters. And also in its post meeting conference, the ECB emphasized the fact that it was not going to commit to a particular or a set rate path, but that it would rather be taking a data-dependent, meeting-by-meeting approach in guiding monetary policy. The market is, however, pricing in a 70% chance that the meeting in October will be a rate hold, and that rate cuts would likely resume towards the end of the year. So probably at the meeting in December, a rate cut would resume. But the market overwhelmingly thinks that the meeting in October would be one where the ECB would want to pause and try to assess the impact of the cuts that have happened thus far. In China, exports continue to be a bright spot, really, for an economy that is struggling to boost domestic demand. Export numbers for August rose 8.7% year on year, much higher than the 6.5% that was expected. Imports, however, grew by 0.5%, slower than the 2% that the had expected. Chinese exports to its major trading partners, the US, the EU, and also the Association of Southeast Asian Nations, all rose in the month of August from a year ago. Exports to the EU grew the most, up about 13% year on year, while fuel imports or crude imports by China fell 7% in volume in the month of August. And over in Nigeria, the market was really largely dictated by very tight system liquidity, last week, which was on the back of FX intervention settlements and remitter outflow. So this really created a tight system liquidity last week, which saw overnight and OBB rates really remain elevated in the 30 regions. The T-bill market opened the week on a bearish note, and this sentiment essentially lingered throughout the week. Again, just driven by the tightness in the market. There was an auction that was held midweek where the DMO offered and sold about 168 billion worth of treasury bills across the curve. Despite the liquidity shortfall, the auction was oversubscribed with stock rates coming in lower than previous auction. The 90-day paper closed at 16.63%, which was 37 basis points lower than the previous auction close. The 180-day paper was 50 basis points lower than previous auction closed at it closed at 17%, while the 1-year paper came in at 18.59%, which was 35 basis points lower than the previous auction. Despite the post-auction demand, the markets closed the week sort of softer, particularly because again liquidity remained tight. So you had market participants essentially more trying to raise liquidity to shore up their own positions. Sentiment in the bond market was largely the same. Again, we saw some selling pressure at the mid to the long 10-odd bonds. The week, however, then concluded with investors being a bit more adopting a cautious approach, if you will, particularly following the postponement of the September bond auction to the 23rd of September. Also, we saw inflation numbers come through, which printed at 32.15. Again, just continuing that disinflationary trend, somewhat stronger that we saw that commenced essentially last month. Again, this is providing a bit more impetus to the monetary authorities to probably keep these rates going further down or keep them lower than we had seen in the previous couple of months. So, in a nutshell, the market this week will largely again be determined by the sort of liquidity that we're seeing in the system, and if that is anything to go by, we are likely to see that bearish trend also continue in the market. While for the US and essentially global markets, the Fed rate decision would prove very, very pivotal in determining what happens in the near to the medium term. The market would essentially be looking for, beyond the rate cuts, clarity in terms of forward guidance, in terms of how the Fed is assessing and thinking about the labor market and what the rate path is likely to be. Thank you very much for your time, and we hope that you have a very, very productive week. Take care.